So here is the big question on everyone's mind. Are income taxes going to be completely abolished next year? Let's cut right to the chase. The short answer is a hard no. There are no serious proposals in Washington to completely get rid of the federal income tax. The real story, the one that's going to impact every single working American, is the one Washington is scrambling to figure out right now. This isn't just a tiny tweak or some minor adjustment for inflation. We're talking about a full-scale demolition of the current tax code, scheduled to happen automatically at midnight on December 31st, 2025. If Congress fails to act, it will trigger the largest tax increase for the middle class in a generation. Now, there are always some fringe ideas floating around about replacing it with something else, but none of that is part of any real legislative push. But that doesn't mean the story ends there. In fact, we are on the verge of the biggest, most dramatic change to your paycheck in decades. But here's the killer detail most people missed. For individuals and families, almost all of those changes were temporary. They were written with a built-in expiration date. On January 1st, 2026, the entire tax code would snap back to the way it was in 2017. Tax rates would jump back up across the board. The top rate, for instance, would go from 37% back to 39.6%, but the pain would be felt by everyone. The 12% bracket would revert to 15%, the 22% bracket to 25%, and the 24% bracket to 28%. What would the one big beautiful bill or OB actually do if it passes? It's a sweeping plan that would address the expiring TAA provisions head-on. It's not a simple extension. It's a proposed permanent restructuring. The 7 tax brackets of 10%, 12%, 22%, 24%, 32%, 35%, and 37% would become the law of the land, preventing that painful snap back to the higher rates of the pre-TEA era. The UP proposal wouldn't just make that larger deduction permanent. It would actually increase it. Under the proposal, the new law would lock in and further boost the standard deduction. This would provide a massive sense of certainty for households and businesses trying to plan for the future. You could look at your income and know that the fundamental math of your tax liability won't be changing year to year from 2025 through 2028. The most talked about of these is a potential new deduction for overtime pay and tip income for certain taxpayers, with vehicle prices and interest rates remaining high. A deduction that would let you write off up to $10,000 in auto loan interest is designed to ease the financial burden of buying a car. However, this benefit would phase out for higher income earners. These new targeted deductions represent a potential shift in tax policy, moving beyond broad strokes to address specific, everyday costs faced by millions. This is a brand new concept, which would allow workers in industries that rely on tips and overtime to shield some of that extra income from taxes. The OB proposes to make the $2,000 child tax credit permanent and then enhance it. The outcome of this legislative battle will solidify the tax landscape for the foreseeable future, which means you can start moving from a position of uncertainty to one of strategic planning. Right now, your withholding is based on today's laws, but the entire system could be upended in 2026. The IRS has a tax withholding estimator tool online. Get a copy of your most recent pay stub and use that tool. It allows you to see if you are having too much or too little tax taken out of your paycheck right now. Having too much withheld is like giving the government an interest-free loan. This doesn't mean you should stop giving, but it does mean you should be smarter about it. One powerful strategy is bunching. Instead of giving, say, $5,000 to charity every year and getting no tax benefit, you could bunch several years' worth of donations into a single year. If the current tax rates are made permanent, they will still be historically reasonable, but there is no guarantee they won't be raised a decade from now to deal with the national debt that makes saving in a Roth 401k or Roth IRA more attractive than ever. The debate is raging, and a proposal like the One Big Beautiful Bill shows what's at stake. The tax cliff is looming and Washington has to act. The outcome will determine whether we get a new permanent tax structure built on lower rates, a massive standard deduction, and an expanded child tax credit. This debate will bring a level of clarity we haven't had in years, but it also presents a new set of challenges and opportunities. The conversation is no longer about if taxes will change, but about how you will adapt your personal financial strategy to the new reality. From your paycheck to your retirement, the decisions you make today will have a profound impact on your financial future. The landscape is being redrawn. It's time to get to work. With a Roth, you pay taxes on your contributions today at these known rates, and then all of your qualified withdrawals in retirement are 100% tax-free. Are you concerned about how the new rules will affect your family, or are you excited about the potential new deductions? Drop your thoughts and questions in the comments below. I read every single one, and your feedback is what drives this channel. And finally, if you found this breakdown valuable, please give this video a like. It is a huge help and tells YouTube that this is an important topic more people need to see. Thank you for watching and I'll see you in the next video. If you believe tax rates will eventually have to go up, paying the tax now is a fantastic deal. If your employer offers a Roth 401k option, it is absolutely critical that you look into it. It's one of the most powerful long-term tax planning moves you can make. For example, you could donate $15,000 in 1 year. That amount, combined with your other deductions, might be enough to push you over the standard deduction threshold for that year, allowing you to get a tax break. In the other years, you simply take the standard deduction. Another option is a donor-advised fund, where you make a large tax-deductible contribution in 1 year and then recommend grants from the fund to your favorite charities over several years. Having too little withheld can result in a nasty surprise tax bill. Take 15 minutes to run the numbers and, if necessary, submit a new Form W-4 to your employer. This puts you in control, regardless of what Washington decides. Here is your 5-step action plan to navigate whatever comes next. If you own a small business, have a high income, or have a large estate, you need professional advice. A good CPA or certified financial planner can analyze your specific situation in the context of this massive legislative fight and create a custom strategy. An hour with a pro this year could be the best investment you make. The proposal would boost the credit amount to $2,200 per child starting in 2026, to be adjusted for inflation after that. Remember, a tax credit is way more valuable than a deduction. One of the most important is the restoration of 100% bonus depreciation. This is shaping up to be the most significant overhaul of the US tax code in a generation. For many, that question might soon be settled for good if a bill like the OB passes and increases the standard deduction to over $31,000 for married couples and nearly $16,000 for singles. The bar for itemizing becomes incredibly high. Itemizing only makes sense if the sum of your specific deductions like mortgage interest, state and local taxes which are still capped, and charitable gifts exceeds that standard deduction. Take a look at your last tax return. For more than 90% of taxpayers, that number will be far below the new proposed amounts. Understanding this simplifies your financial life and means you can stop obsessively tracking every little receipt. Staying informed is your single best defense against being caught off guard. Do me a quick favor and hit that subscribe button and make sure your notifications are turned on. I'll be tracking every detail of how this debate unfolds, from new proposals to last-minute changes, and breaking it down for you right here. This would allow businesses to immediately write off the full cost of new equipment and investments, rather than deducting it over many years. A powerful incentive for companies to invest in new machinery and technology. The bill would also make the 20% deduction for qualified business income (KB) for pass-through entities like sole proprietorships and partnerships permanent, a critical tax break for small businesses. However, the bill would also likely be paid for in part by repealing some of the green energy tax credits passed in the Inflation Reduction Act, which would create a clear set of winners and losers. A deduction just lowers your taxable income, but a credit reduces your actual tax bill, dollar for dollar. This proposed increase from $2,000 to $2,200 would be a direct cash-in-pocket benefit for qualifying families. The bill would also make the higher income phase-outs permanent, meaning more middle and upper middle-class families would continue to qualify for the full credit. This is a critical piece of the legislative puzzle, as allowing the credit to be cut in half is seen as politically unacceptable by both parties. The bill even proposes some extra inflation adjustments for the lower and middle income brackets, meaning you get to keep a little more of your money before being pushed into a higher bracket. This single act would prevent what would otherwise be the most widespread and immediate tax increase. Let's look at the 5 most important potential changes and what they would mean for you. Think of it like a subscription service for lower taxes that's about to be automatically cancelled. At the center of it is a monumental proposal that some have nicknamed the One Big Beautiful Bill, or OB for short. The goal of this bill isn't just to stop the tax code from falling off a cliff. The plan is to fundamentally reshape it. That disaster has a name: the Tax Cuts and Jobs Act of 2017, or TEA. This was the law signed by President Trump that completely rewrote the individual tax code. It lowered the tax rates for most people, it dramatically increased the standard deduction, it doubled the child tax credit, and it capped controversial deductions like the one for state and local taxes, better known as SALT. It aims to make some of the biggest tax cuts in recent American history permanent, while adding a whole new set of targeted benefits. You see, a massive, sweeping tax law that has defined your take-home pay for the last 8 years is set to simply expire, and because of that, a dramatic, down-to-the-wire battle is brewing. In this video, we're going to break down exactly what is at stake, what this epic legislative fight is all about, what it could mean for your paycheck, and what you need to do now to prepare for whatever comes next. Section 1. The elephant in the room, the tax cliff we're all hurtling towards to understand just how high. The stakes are you first have to get your head around the disaster that all of this is designed to prevent. For the last 8 years, these rules have determined how much money is withheld from your paycheck and how much you owe the IRS every April. If that cancellation happens, the consequences would be immediate and severe. The standard deduction, which was nearly doubled by the TEA, would be slashed almost in half. Section 2. Breaking down the proposal. What would the one big beautiful bill actually do? So let's break down the proposal that has Washington in a frenzy. Proposal number 1. The lower tax rates would be here to stay. First and foremost, the OB would make the lower individual income tax rates from the TEA permanent. This is the cornerstone of the entire proposal. Proposal number 2. The standard deduction would get even bigger. The TEA was famous for nearly doubling the standard deduction, which simplified tax filing for millions of Americans. Proposal number 3. The child tax credit would be expanded for the more than 40 million American families with children. This would be a huge deal. Proposal number 4. New targeted tax breaks for workers. Beyond just extending old provisions, the OB proposal introduces several innovative, temporary tax breaks aimed directly at working Americans. Another significant new break being floated is a temporary deduction for interest paid on car loans. Proposal number 5. Big changes for businesses and investors. The proposal also includes significant changes on the business side. If all these details are making your head spin, you are definitely not alone. Section 3. Your personal action plan. How to prepare for the new tax world. Knowing what's being debated is one thing. Knowing what to do about it is another. Tip number 1. Reevaluate your withholding immediately. This is the most urgent step for every single person who earns a paycheck. Tip number 2. Determine if you will likely be a standard deduction filer. For years, the decision to itemize or take the standard deduction could change. Tip number 3. Rethink your charitable giving strategy. If you are one of the vast majority who will likely take the standard deduction, you won't get a direct tax benefit for your charitable donations. Tip number 4. Maximize your tax-advantaged retirement accounts. The one constant in a changing tax world is the power of a 401k or an IRA. Tip number 5. Consult a professional for complex situations. While a new law might provide more certainty, it will also include complex new rules. So will income taxes disappear next year? No, but they are on the cusp of a fundamental change. What are your biggest questions about these historic tax changes?